Okay, you should be able to see chapter 26 now. Can you see chapter 26 on your screen? I don't hear any comments, so I suppose that we can see it.
Can see it.
All right. Okay, what we're going to talk about in capital investment analysis is that our company is going to be thinking about investing in certain types of assets, and they're going to want to be looking at different types of assets that they might want to invest in. And so we need a way to evaluate those investments before we actually invest any money into those investments. So what we talk about as far as capital investments, these are going to be large amounts of money that a company is planning to invest in, and they might have several different types of assets that they want to invest in. And as management, we need a plan to be able to evaluate those assets, or to be able to screen the particular assets that we think that we might want to invest in. And so there are going to be 4 different methods that we look at in this chapter to help us to evaluate the choices of investment opportunities that a company might have. The first 2 methods that we're going to look at are not going to use what we call present value analysis. They're very simple methods that will allow us to calculate or evaluate whether or not we need to invest in certain types of analysis. And they are simple methods that we're going to start with, where they do not use present value techniques. One of the methods that we're going to use for evaluation purposes is going to be what we call the average rate of return method. The second one that we're going to look at today is the cash payback method. And the other 2 I'm going to put off until a later class meeting to talk to you about. These first 2 are rather simple to do, and so I'd like to look at those first if we can. So the first method that we're going to be using is what we call the average rate of return method. And you can see here that there's a formula for calculation of the average rate of return. First of all, what you're going to have to do is you're going to have to figure up the estimated average annual amount of net income. So we're going to, as a company, determine what we think the amount of the annual income will be that our asset is going to contribute to us over a period of time. And we're going to find the estimated average amount of annual income first, and then we're going to divide that by the average investment. So this formula right here is really 2 formulas in one. You're going to have to determine how to come up with the estimated average annual income, and you're going to also have to come up with the average investment before you can determine the average rate of return on the investment. So in order to calculate the average investment, we will need to know what the cost of the asset is going to be, the initial cost of the asset, and then we're going to add back to it something that we call the residual value. The residual value of the asset is the scrap value, or it's the amount of the value after the asset has been depreciated. You might remember from ACC 120 when we talked about calculating depreciation, we would need to determine the residual value. The residual value is the leftover amount of the asset after it's been fully depreciated. Sometimes we can refer to that as the scrap value, but in this chapter they're calling it residual value. To determine an average amount, we would take the cost plus whatever the residual value is for that asset, or what we think it's going to be. We're going to divide it by 2. Whatever this amount comes up to is going to be plugged into the formula to determine the average rate of return. It's going to go in as the denominator. So we also need to find the numerator. To determine the numerator, we're going to add up all of our annual income over the life of the asset, and then we're going to divide it by the life of the asset, and that will give us the estimated average annual amount of net income. So let's look at an illustration where they have us doing this. First of all, they tell you what the cost of the asset is going to be. So that could be plugged into the average investment formula. They tell you that the residual value or the scrap value is going to be 0. So the initial cost would be $500,000 plus the residual value of 0 means that $500,000 would be divided by 2 to get the average investment, which would be $250,000. That's how I would come up with the average investment amount. That is the denominator. The numerator of this formula is to determine the estimated average annual income. So let's do that now. They have added all the income together for this company's asset that they are intending to purchase. They're purchasing a new machine, and they believe that that machine will have a useful life of 4 years. So over the 4-year period, the total amount of the income that they think that they're going to produce from the purchasing of this machine is going to be $200,000. So we would add all of the M up for the 4 years, and they're giving you a total amount of $200,000. That $200,000 is going to be divided by the expected useful life to give you the amount of the estimated average annual income. If we take 200,000 and divide it by 4 years, it will give us 50,000. So if we're determining our average rate of return, we're going to take that 50,000 and we're going to divide it by the average investment, which we found was 250,000, and what that will give you is a 20% return on the investment. So what we would do is we would determine all of the assets that we are thinking about buying. We would determine the average rate of return on each one of those assets. and then we would decide which one has the highest average rate of return. And if it meets our expectations for management, then we would choose that asset to evaluate further. You'll remember that we said that we're going to evaluate our assets, and I'm going to go back for just a minute, by these methods here. The average rate of return is one of the methods. We're going to look at the cash payback method also, and then we're going to do present value methods. There are two of those, the net present value method and the internal rate of return method. So we would subject that machinery that we were talking about before to the average rate of return. If it meets management's expectation, then we would further look at that asset through the cash payback method. If it meets the cash payback method, if it meets management's expectation for the cash payback method, then we would go on and subject it to the next type of evaluation method. So these methods are evaluated in order, or the asset is going to be evaluated by each one of these methods. We would start with the simplest methods first and evaluate those assets. And then if it meets our expectation, we move to the next method, evaluate it. And if it meets our expectation, we'd move to the next method and evaluate it further. And if it meets our expectation there, we would evaluate it yet again. So we're using all of these methods to help us to evaluate potential purchases of assets. So in this first asset that we looked at for our machinery, we can see that we're getting a 20% return on our investment. And we should compare that to the minimum rate of return that is required by management to see if it meets our standard. The advantages of using the average rate of return is that it's easy to calculate. Just put it into that formula and we can calculate it fairly easly. Another advantage is that it includes the entire amount of income that's earned over the life of the proposal. You'll remember it took into consideration the average annual income. So it takes into all of the income that we are thinking that this asset will provide for us over the life of the proposal. And that's an advantage of using this method. Also, it emphasizes accounting income, which is also often used by investors and creditors in evaluating management performance. So accounting income would be the estimated amount of income that they think that this asset is going to be producing for us over the entire life of the asset. So it has some advantages by using this method, and it's simple to use, and so the management uses this as the first method of evaluation for investments that they are thinking about investing in for their company. Some of the disadvantages is that it's not subject to the cash flows from the proposal. In other words, in our formula, we did not evaluate the cash flows that we are going to get from this particular type of machinery. That would be a part of present value analysis, which we would subject this asset to later on if it meets management's expectation for the average rate of return first. It also does not consider the timing of the expected cash flows. So in other words, the disadvantage about this method is it doesn't take cash flows into consideration when you're using it. It's a very simple method that we can use to help us to evaluate between alternative methods of investment. And it's the first one that we would subject our investment to. So that's the first method. The second method that we would subject the asset to is what we call the cash payback method. And the cash payback method helps us to determine what we call the cash payback period. In other words, management will want to know how long it's going to take them to pay off that investment in terms of what we're earning from that investment. So we want to know how long it's going to take us to pay back that particular investment. And so the cash payback period has a simple method or a formula that we will use to determine the cash payback method. First of all, we got to determine what we believe the initial cost of the asset is going to be. Then we will divide that by the annual net cash inflow amount. The cash inflow is what we're expecting this asset to generate for us. And so the initial cost would be divided by the annual net cash inflow, and that would give us the cash payback period. The cash payback period would have to meet management expectations in order to further evaluate this method as an investment. Now, what they've done here is they've shown you how to calculate the net flow for this investment over a period of time. What I've noticed is that in your problems, they will give you the net cash inflow. Most likely, you're not going to have to figure out what the net cash inflow is for each one of the investments. They just give you the amount. But if you're curious about how they come up with it, this is how we would determine our net cash inflows for the year, for the asset, for each year. And so they're doing it on a per year basis. For the example that you're looking at here, they tell you that they think that they're going to have $50,000 in cash that's going to result from the purchase of this new machine. In other words, this new machine is going to generate some cash for our customers, and that cash amount was $50,000. We're going to subtract out the cash expenses of the machine. The expenses of the machine would include the depreciation. In this case, the expenses of the machine was $30,000. We could possibly get this off of a potential income statement budget that they would do for that particular machine. And so what they're anticipating is that there are going to be some expenses of operating this new machine in this period of time. And it's going to include the depreciation for the machinery. Now notice that in order to find the cash inflow per year, that they determine what the depreciation is that machinery during that year. They're estimating what they think it's going to be, and they are taking it out of the total expenses for this machinery because depreciation does not require a cash outflow. There's no cash outflow associated with depreciation, so they are subtracting it from the total of their expenses, and that will leave them with the expenses that they believe they will have to pay some cash for, and those expenses are $10,000. So the difference between what they think they're going to bring in from the machinery in cash, what they're going to have to pay out as far as cash is concerned for that machinery, the difference is a inflow of cash of $40,000. So each year they're thinking that for the life of this machinery, they're going to have an inflow of cash of $40,000. In order to find the cash payback period, we would take the cost of that asset, which was $200,000, and divide it by the $40,000 in cash that we expect to get from the operations of that asset. And this asset will recover its cost in 5 years. So the cash payback period is just saying, well, if we make an investment of 200,000, how many years is it going to take us to recover the cost of this investment? And we're believing that we can bring in additional cash flows to our company of $40,000 per year. It will take us about 5 years to recover the cost of that asset. So the initial cost divided by the annual cash flow is the cash payback period. It will take us 5 years to recover the cost of the asset. In this part, they're showing you a graphic analysis of a different asset that they might want to purchase. And it says to illustrate, assume that a proposed investment has initial cost of $400,000 and that the annual and cumulative net cash flows over the proposal's 6-year life are as follows. Notice in this case, the 6-year life has net cash flows that are not equal in amounts. In other words, they think that when they use this particular asset for the first year, that they're going to receive cash flows, net cash flows from the use of this asset of $60,000. In year 2, they're anticipating that that cash flow is going to increase to $80,000. In year 3, they think it's going to increase to $105,000. So each year that they're using this asset, they're determining each year's cash flow that they're going to get from the investment of that asset that cost them $400,000. So if we are calculating the net cash flows with an equal amount, yes, I hear somebody's about to ask a question. Hello? Do I have a question? Okay, you decided not to ask the question? All right. The difference between this investment of $400,000 and the one we did previously is we knew that the amount of the cash flows per year was going to be an equal amount. If it's an equal amount, we simply divide the cash flow amount into the cash payback period, and it'll give you 5 years to pay that back. If the cash flow is unequal in amount, then we'll use what we call the cumulative net cash flow to determine the number of years that is required in the cash payback period. So in the first year, the cash flow was $60,000. In the second year, it was $80,000. We would add the two cash flows together from year one and year two, and that will give us the cumulative cash flow of $140,000. Because this asset is going to cost us $400,000, we know that we are not going to recover the cost of the asset in 2 years, so we go on to the next year. The next year, we think the cash flow is going to be $105,000. We would add that to the 2 previous years to get a cumulative amount of $245,000. So these 3 added together is $245,000. That still does not recover the cost of the asset. So we know that it's going to take more than 3 years to recover the cost of the asset. Notice in year 4, the the net cash flow for year 4 is $155,000. We would add that amount to the previous years to get the total cumulative cash flow of $400,000. That $400,000 means that we are going to be able to recover the cost of our asset in 4 years. What this graph does is it just shows it to you visually as to what happened. In the first year, our cash flow was $60,000. In the second year, we added $80,000 to that for a total of $140,000, which would not recover the cost of the asset yet. So we add the next year to get the cumulative amount of $245,000, which still doesn't cover the cost of the asset. And then in the fourth year, it equals up to be $400,000, which is the exact amount of the cost of the asset. And so we have recovered the cost of the asset in 4 years. Any cash flow above that just adds to our profits. Is there a question about what I just did there? So when we're talking about the cash payback period, if we know what the equal amount of the cash paybacks are, we divide the equal amount into the initial cash or initial cost, and that will give you the amount of time that it's going to take for this asset to recover the cost of the asset. In the second example that we looked at, the cash flows were not equal, so we have to use the cumulative amount of cash flow to determine the cash payback period. And so what we mean by the cumulative net cash flow is that we're adding each year's cash flow until we recover the cost of the investment. Now, something that could happen if you're using the cash payback period is there's a what if here. What if the proposed investment had been $450,000 instead of $400,000? And if we were using the same net cash flow amounts for each year, what would happen is And year 4, we would reach 400,000, but that's not the cost of the asset, the new asset, or the what if analysis is saying, what if it's going to cost us 450,000? We would go on into the next year's cash flow. But if you add the entire amount of cash flow, the cumulative cash flow goes over the cost of the asset. So what you have to do is you have to back up, and you'd have to say, well, if the cost of the asset is 450,000 and I'm expecting net cash flow in year 5 to be 100,000, I don't need the entire amount to recover the cost of our asset. I only need 50,000 of this $100,000 amount. Or in other words, I need a half a year in addition to the 4 years to make it 4.5 years before I could recover the cost of my investment. So some advantage of the cash payback method is pretty simple to use. You just either put the equal amounts into the formula, or you add up all the net cash flows to determine when the cost of the asset has been recovered. Another advantage is that it does use cash flows in order to figure out how long it's going to take for you to recover the cost of the investment. But it also has some disadvantages. First of all, it ignores the cash flows that occur after the payback period. So with the cash payback period, we just are looking at the number of years it takes us to recover the cost of the asset. It ignores the future amount of cash payments that we could be receiving, or cash flows, receipts that we could be receiving in the future. And it doesn't use present value concepts in valuing the cash flows that occur in different periods. So it has some disadvantages associated with it. But what we would do as a company is we would evaluate our investment first by using the rate of return method, the average rate of return method. If it passed management's approval, then we would subject it to the cash payback period. And if that was approved by management, then we would subject it further to the present value techniques that we're going to talk about the next time that we meet, or if we don't get to talk about them on Thursday, then we'll definitely do it next week at some point in time. So I just wanted to talk to you about those first two methods because I want to go into a problem the next time that we meet that will show you how to do those methods, and then I will further expose you to the net present value methods. So thank you for listening to me today. Do I have any questions about this so far that we've talked about? I'm going to stop sharing then.